Right, first of all, let's start with stamp duty land tax. There is a plan to reduce the SDLT payment and filing date to 14 days from the date of a transaction. But they've now delayed this by a further year, so it won't take effect until April 2018. You'll see there that there are no planned increases to stamp duty land tax, thankfully, but you'll see from the table below that the different rates that you could pay are quite complex, and it can be quite a job to work out what rate should apply to any given transaction. One thing I would highlight is with mixed property, where you, say, acquire a house with some land or with non-residential buildings, you'll see that they benefit from the much lower rates compared to a residential property. And so if you have a mixed property acquisition, then that should be thought through carefully as to whether it is mixed property. And even those who've already paid stamp duty on the basis that it's a residential property, you can, in certain circumstances, claim a refund of overpaid stamp duty. Transaction in land rules, these were introduced last year, and the publicity around these rules was that they were aimed very much at offshore property developers. However, they've got much larger scope than that, and I think it'd be useful just to highlight what these rules are. Basically, if these rules apply, then any profit or gain realised from the disposal of the land will be liable to income tax rather than capital gains tax. Now, you're okay in terms of the profit which was attributable to the period before you intended to develop or sell the land, but any profit above that will be subject to income tax. Now, you'll see that it applies if one of the main purposes of acquiring the land or acquiring property deriving its value from land was to realise a profit or gain from the sale of the land. Okay, so that could be quite wide. Also, if you have developed land and one of the main purposes of developing the land was to realise a profit from selling the land, then you could be caught by these rules. So I think what these rules could catch would be collaborations of landowners who might pool their land together or grant options over each other's land in order to sell land to developers. Because I think that could be caught by one of the main purposes of acquiring property deriving its value from land, which would be an option over land or going into a pool. Alternatively, it could catch one-off property developers. So a farmer who may have owned his land for a long time suddenly wants to develop a house on that land and then sell it. Again, the farmer could be caught for income tax on that profit. Business rates. There's been a lot of publicity around this, and essentially they are aimed at helping out small businesses who are coming out of the small business rate relief. And you'll see also they've got a £1,000 business rate discount for pubs with a rateable value of less than £1,000. VAT, there's going to be an increase in the VAT registration and deregistration threshold of £2,000. There's also some changes to the VAT flat rate scheme. Now, this scheme is aimed at smaller businesses with a turnover of less than £150,000 per year. And essentially, these businesses benefit from quite a low flat rate of VAT. However, the government are introducing a new VAT flat rate of 16.5% for those businesses with limited costs. What we mean by that is where the business spends money on goods such as gas, fuel, electricity, stock of less than 2% of their turnover, or if greater than 2% of their turnover, less than £1,000 in total per year. So those type of businesses will now pay a flat rate of 16.5%. So in many cases, they may be better off just paying the standard rate of VAT. Other changes. Now, the government has called for evidence on a new VAT collection mechanism for online sales, so that the plan is that they would extract money to the government directly from online transactions. There's also a consultation document which is due to be published on the 20th of March, and that's aimed at combating fraud in the construction sector. particularly on the supply of labour. So they're looking at imposing a requirement to account for VAT on the recipient of the labour. At the moment, the responsibility to account for VAT is on the supplier of the labour, so that could be quite a big change. They're also looking at potential changes to the qualifying criteria for gross payment status under the construction industry scheme. Partnership tax, the government announced a 1% increase in the main rate of Class 4 national insurance contributions which self-employed people pay, including partners of partnerships. And you'll see there that the first increase will take effect from April next year. So it'll take the main rate up to 10% and then by a further 1% from April 19. Now, they're also looking at partnership tax generally and seeing how they can improve things. And so one of the proposals is that if you've got a partnership which has a partnership or LLP as its partner, then they will look through that partnership or LLP and look at the underlying individuals behind that partnership in the way that they tax the partnership. They're also looking at the way that partners allocate their profits between each other. And so they're looking at imposing a requirement that any partnership profits or losses are allocated between the partners as per the accounting profit or loss. Benefit in kind, there's quite a few changes in this, the most notable of which is the reform of salary sacrifice. So the government are removing the income tax and employer NIC advantage on benefit in kind offered through salary sacrifice, such as on mobile phones, gym memberships, school fees, accommodation, etc. So instead of these being taxed on the value of the benefit, and not paying tax on the salary sacrificed, instead they're looking at taxing the higher of the salary sacrificed and the taxable value of that benefit. So quite a big change there. The changes won't take place immediately. There is a transitional period, and you'll see there's a long stop date of April 2018, and there's a carve out for school fees, salary sacrifice, because that's extended to April 2021. Having said that, it's a good opportunity for those with salary sacrifice contracts or policies, review them now, and if necessary, change them before April this year. Because if that contract ends shortly after April this year, or it needs renewal or change, then that benefit will end immediately on that date. So if you want to make the most of the transitional period, now's the time to look at salary sacrifice contracts. There are a number of benefits excluded from salary sacrifice, and you'll see there pension saving into registered pension schemes. So the government do still see that as a key thing, and also childcare vouchers. Okay, there are also announced changes to disguised remuneration legislation. Now this is legislation aimed at combating tax avoidance through the use of provision of benefits through employee benefit trusts or other third parties. And essentially what they're trying to do is, if you haven't closed down your scheme by April 19, then there'll be severe penal tax charges. The other thing they're doing is amending the legislation to make sure that it puts beyond doubt that any future tax avoidance disguised remuneration schemes are closed down. Termination payments, so from April next year, they're changing it so that any contractual or non-contractual payments in lieu of notice payments are taxable as earnings and won't enjoy the benefit of the £30,000 exemption. Employer national insurance contributions are now payable on the element of the termination payment above £30,000. Previously they weren't. Public service companies in the public sector, so this could typically be an IT contractor company performing work for the local council or NHS. Now at the moment the rules impose the responsibility for operating the PAYE and NIC on the personal service company if the worker behind that company is deemed to be an employee of that public sector body. However, from April this year, the tax risk for operating that PAYE and NIC will actually fall on the public sector body. So I think we'll see quite a big change in this area. So firstly, I think public sector bodies will scrutinise very heavily the operation of a personal service company and really try and fully analyse whether actually they're effectively an employee. I think we'll see a move towards project-based contracts and a move away from more open-ended contracts. And I think you might see some public sector bodies not going through any analysis and simply looking to operate PAYE and NIC. Apprenticeship levy, this is a new tax from 6th of April, payable at a rate of 0.5% of a company's annual pay bill. That excludes benefits in kind. But there is a £15,000 allowance, so it essentially means that only employers with an annual pay bill of more than £3 million will pay this levy, and you'll see there that for an annual pay bill of £3.5 million, you're looking at a levy of £2,500. Having said that, if you've got various companies within the same corporate group, then that £15,000 allowance is split between the whole group, and it's up to group company members to decide who has more of that allowance or not. So you could see a situation of some group companies paying this levy even if they have an annual pay bill of less than £3 million.